Hey everyone, welcome back to The Explainer. Today, we are putting on our equity analyst hats for a rigorous, absolutely zero fluff valuation of Boot Barn Holdings, ticker symbol BOOT. We're going to dig right into the financial filings, run the hard numbers, and figure out if this company is actually worth what the market is currently telling us.
So let's frame our central mystery here. Right now, a single share of Boot Barn will cost you exactly $171.47 on the open market. But as we know, the ticker price is really just a popularity contest. What we're really after is the intrinsic value, the actual underlying cash-generating power of the business. We've got to separate all that market enthusiasm from the cold, hard math.
And trust me, the market has been very enthusiastic. Just take a look at this massive number, 1,946.18%. That is Boot Barn's historical 10-year total return. I mean, this is a business that has absolutely exploded, making its early investors incredibly wealthy. But here's the catch. Sky-high past growth makes our valuation today even more critical. Trees don't grow to the sky, right? We need to know for sure if you're buying into actual future growth or if you're just paying a hefty premium for past glory.
All right, here's our game plan. We're running Boot Barn through our analyst's funnel, starting with price versus value, moving into absolute valuation to project those cash flows, checking out relative valuation to compare against peers, finding the absolute floor with asset valuation, and finally synthesizing our final verdict. Let's get right to it.
Section 1. Boot Barn, price versus value. Let's establish the market reality.
The tension here is immediate. Up against the current market price of $171.47, our calculated baseline fair value actually sits lower at $163.97. So right out of the gate, we're seeing a negative margin of safety of negative 4.57%. The baseline models are practically screaming that the market is already paying a premium. Our job now is to rigorously test that baseline.
Section 2. Absolute valuation, modeling the future, projecting cash flows and income.
To do this, we're going straight to a discounted cash flow model, or DCF. Here's the step-by-step logic we pulled from the documents. First, we start with the trailing 12 months free cash flow, which sits at a super healthy $88.8 million. Step 2 is applying a growth rate. Now, Boot Barn has this insane 3-year free cash flow compound annual growth rate of 39.93%. That's massive, but let's be realistic. They literally cannot sustain 40% growth forever. So in our model, we taper that growth down over the next decade, eventually settling into a sensible terminal growth rate of roughly 2 to 3%. Finally, step 3, we discount those future cash flows back to today's dollars using a weighted average cost of capital, or WACC. Because Boot Barn has an ultra-low debt-to-equity ratio of just 0.01, their capital structure is almost entirely equity. Because of that, we applied a standard 8 to 10% discount rate here to properly account for equity risk. Now, normally an analyst might also run a dividend discount model at this stage, but we can use the process of elimination here. Since Boot Barn's dividend growth rate is exactly 0%, meaning they pay out absolutely zero dividends, opting instead to reinvest all that cash right back into the business, the DDM is just completely inapplicable. So we're going to scrap that and pivot straight to our backup absolute model. And that backup is the residual income model. Now, I know this sounds a bit complex, but it's actually quite elegant. It starts with the company's current book value of equity and then measures whether the business is actually creating value above its cost of capital. We know from the data that Boot Barn boasts a very strong 17.07% return on equity. That high ROE feeds directly into our model, confirming that, management is highly effective at turning shareholder equity into excess profit. When we map it all out, this residual income approach yields an implied per-share value that aligns really closely with our DCF output, keeping our baseline fair value firmly around that mid-160s mark.
Section 3. Relative valuation, peer comparisons, judging by the multiples.
Before we look at the numbers, I want to be completely transparent with you. Because specific direct Western wear competitors just aren't broken out in the provided documents, we're operating under the assumption that Boot Barn should be compared against general retail apparel benchmarks. It's a necessary proxy, but definitely an important bit of context to keep in mind as we go.
All right, let's examine the classic price-to-earnings, or PE ratio. Boot Barn's current PE is 24.05, but notice how the forward PE drops down to 1946. This is a great sign. It suggests the market expects their earnings to continue growing robustly over the next year. And when you compare that current 24.05 multiple against its own trailing average PE of almost 26, well, the stock actually looks slightly cheaper today than it has in its recent past. If Boot Barn were to simply revert to that historical trailing average PE of 25.87, it implies a relative share price closer to $184.
We can round out the relative valuation by checking some secondary multiples. EV to EBITDA sits at 13.70, which has actually cooled off by about 5% from its trailing average. However, the price-to-book ratio is up at 4.07, and EV to sales is at 2.31, both of which are historically elevated compared to their 5-year averages. So honestly, the relative story is a bit mixed. Earnings multiples suggest a slight discount, while sales and book multiples suggest it's gotten a bit pricey. Blending these retail benchmark multiples together gives us a relative valuation range that basically hovers right around current market prices, offering no clear, screaming discount.
Section 4. Asset Valuation, the floor. Calculating net asset value, or NAV.
The formula here is super simple. Take total assets, subtract total liabilities. As we've mentioned, Boot Barn's balance sheet is incredibly clean. A 0.01 debt-to-equity ratio means they owe virtually nothing. Their liabilities are minimal, which yields a strict net asset value of roughly $42 per share. But here is why we really don't rely heavily on that $42 floor for a stock like this. Boot Barn has a price-to-book ratio of 4.07. That means the market is valuing the company at over 4 times its literal accounting equity. A pure NAV model heavily undervalues a high-growth retailer, mainly because Boot Barn's real value comes from its future sales and brand power, not from, liquidating store fixtures and cowboy dudes.
Section 5. Final verdict, intrinsic value range. Synthesizing the models.
Okay, we've run the numbers through our funnel. We've looked at the cash, the multiples, and the assets. So the absolute crucial point is that in our final weighting, we really must rely most heavily on the absolute discounted cash flow model. It's truly the only method that captures Boot Barn's massive 40% free cash flow growth. But we also have to acknowledge its biggest weakness. It is highly sensitive to our baseline economic assumptions. If that terminal growth rate drops below 2%, or if the cost of capital spikes above 10%, the intrinsic value just plummets. And that brings us to the climax synthesis. When you line up all the implied per-share values from our models, a really clear picture emerges. The DCF model outputs a fair value of $163.97. A pure earnings model gives us a fair value of $156.58. The asset value is trailing way behind at an implied $42. Notice a trend? All of these calculated intrinsic values sit below the current trading price of $171.47. The math is flat out telling us that the market is currently pricing Boot Barn higher than the strict fundamentals dictate. So, here is the final judgment delivered clearly. Based purely on the financial documents and standard equity modeling, Boot Barn is currently trading at a premium to its calculated intrinsic value. With fair values resting in that $156 to $163 range, investors looking to buy in today are facing a negative margin of safety of between 4.5 and 9.5%. Our final verdict? The stock is slightly overvalued at today's price of $171.47.
But I want to leave you with a provocative thought here. Traditional value investing tells us to wait for a discount, but growth investing tells us that premium companies often command premium prices. Is a negative 4.5% margin of safety an acceptable risk to take on a retail stock that has proven it can deliver 1,946% return over a single decade? Does Boot Barn's explosive historical growth justify paying just a little bit more than intrinsic value today? Well, that is the ultimate question you have to answer for your own portfolio. Thanks so much for joining me on this deep dive into the explainer, and as always, keep running the numbers.